Ladies and gentlemen, welcome to what I think will be a fascinating panel on the state of primary markets. As Brian highlighted, primary bond markets are at the heart of what ICMA does and what almost all of the member institutions at ICMA focus on. And I know from conversations with a lot of you over the last couple of days that people have very strong views on primary. They have strong views on what works well, what doesn't work so well. They have strong views on the past of primary, the present, and the future. And hopefully, we have a great group of experts here to investigate some of those topics and talk about the challenges, but also the opportunities in primary in the weeks, months, and years ahead. So to introduce our panelists, to my right, we have Frank Engels, CIO of Union Investment. Then we have Jocelyn Hebert from the ESM, who is their expert on digital innovation. Reiko Hayashi, the Director and Deputy President of Bank of American Securities Japan, and Isabelle Laurent, the Deputy Treasurer and Head of Funding for the BRD. So I want to start today by talking about something which I think we all take for granted, but the changes in how we've done business over the course of the last couple of years as we've gone through a pandemic. Primary markets, obviously, from a pure numbers perspective, performed incredibly well. The sheer volume raised, the ability to continue to be open and active through volatile conditions, and when almost all of us were not in a position to work from our usual office environment, was incredibly impressive. But what has changed in terms of how we look at the primary markets today versus 3 years ago? So maybe, Frank, if I can start with you, how do you see, from an investor perspective, the primary markets today versus pre-COVID?
Thanks a lot, Marc. I mean, obviously, you mentioned it. We went fully digital. We are now hybrid in a sense. So markets have become very efficient, primary markets, both from the issuer and syndicate side, but also from the investor side. We're participating each year in up to 3,000 new issues. So you need to be fully digital and automatized in your internal processes to be able to digest all the information. Now it helps when you know the issuer. It helps when you know the syndicate people. So it helps to be part of the market for quite a long time and have been part of the market for quite a long time. If you're a new issuer, it's getting more difficult. And I think by the time central banks are or will be withdrawing purchases from credit markets, I can easily see that post-pandemic, it will get more difficult for credit issuance and issuers to tap the market easily in the sort of high-speed fashion that we've experienced ever since we went digital and more automatized. So in a sense, I do think pockets of the market, new issuers or critical issuers where you have to have face-to-face contact and ask the CFO difficult questions. So that would be probably the high yield market. I can easily see that post-pandemic gets a bit more personal, in person again.
That makes sense. And Reiko, obviously it's been somewhat of a different experience, certainly in terms of timeline on the Asia Pacific side. Do Frank's comments chime with you?
Yes, as Frank mentioned, actually, primary market in APAC also functioned very well thanks to the new technology. And then most of market participants could start working from home. And actually, in my case, I started working from home March 25th, 2020, and I just returned to the office last week, finally. So, and still, and so thanks to the new technology like Zoom or WebEx, we could arrange meetings, roadshow meetings quite easily. And then as a capital market person, it was one of my key roles to bring Japanese clients to Europe and then US. And then once or twice a month, I traveled abroad. But for the past 2 years, I didn't do anything. But still, we could arrange so many meetings thanks to virtual matters. And then we could bring about more transactions than before, thanks to the technology, but still it's beneficial to meet the people in person. And then I'm so excited to see all of you in person, and we could have more dialogue or deep dialogue with clients, and then especially for training new grads and then new joiners is more important to have a physical meeting. So, but still hybrid meetings will continue going forward. That's my view.
Thanks, Reiko. And turning now, I think, to one of the topics that people are most excited about and have very strong opinions about in primary going forward, technology and digitalization disruption, if you like. Jocelyn, from your perspective, what are the opportunities for technology to reduce the cost and the time spent issuing bonds from an issuer's perspective? And what are the obstacles against sort of widespread adoption of that sort of technology?
Okay, yes, no, it's indeed a very interesting question. And as you outlined, I think there was an acceleration with the pandemic. So from my point of view, it was a good thing. So when we look at innovation at the ESM, there are three questions we ask ourselves. So the first thing is, does it reduce my costs? Second thing is, does it improve the efficiency of my operations? And the third thing is, does it reduce my risks? So our objective is to strengthen the backbone of the institution. And if one of these three questions is the answer is positive, then it's worth looking into in details. And then what we want to do is to test. That's very important, to test things, because there are many things on the market that don't always deliver on their promise. So that's a very important thing. And I think for the last part of your question, the limits are what's maybe the challenges on all the solutions to digitalize the capital markets. It's really on interoperability, because there are many solutions there. So we can talk a lot about this on tokenization and so on, but without going into details, it's really about compatibility of the solutions and interoperability. And I think here, one of the first steps is to have a common language. And so the work that ICMA is doing within the FinTech Advisory Committee, where I participate, on the Common Data Dictionary is very important. It's a very first step to go into this direction.
Great. And do you think, what's the timeline for major changes in terms of how issuers bring bonds to market, do you think?
Well, I think it depends what you're talking about. There was a very interesting panel yesterday about fintech, where you had different perspectives, and one key thing to go into this direction and really grasp the whole potential brought by DLT and blockchain in terms of automation and making things more efficient is really about having at some point a wholesale CBDC. And I think there was a consensus on this yesterday. So to answer your question on the timeline, it highly depends on this. And then the take-up will also be progressive. I think it will be hybrid for some point, for some moment, and then it will take up progressively. But this is a journey.
Thanks, Isabelle. From your perspective as an issuer, do you think that a lot of change on the tech side is necessary? And there's been some propositions around whether, for instance, an auction is a useful model for new issuance, and whether tech can help with that. How do you see that, and how do you find the friction in your current sort of issuance environment from a tech perspective, and what are the parts where you might need sort of support or further help from the tech side?
So I probably need to preface any response with the fact that this probably reflects more my age and the fact that I'm not a digital native and somewhat of a Luddite. But I definitely see that there's room for technology to simplify certain processes that are repetitive and duplicative and other things. I think that one of the difficulties is we want to make sure that it doesn't disintermediate banks, because banks perform a very useful role in terms of providing information, providing secondary market liquidity and other aspects. And so I'm always very concerned to look at processes that are helpful rather than trying to replace the way things are done, where we might end up with less information rather than more, both for investors and as issuers. I think the auction process for an issuer such as ourselves rather than a government is probably less helpful, because we really want to make sure that bonds are placed with certain investors rather than being placed just in the order of bids, because we would like to have more buy and hold investors, some liquidity, but more buy and hold investors. And of course, when you then want to issue green bonds or social bonds, you want to make sure that they are substantially held, or at least able to be accessed by those with dedicated funds. So the idea that you were to give things in a sort of on the basis of in which orders come, sometimes inflated orders, would be very problematic. So I think that you know, when I've asked the question of the people explaining how wonderful auctions are, they've told me, well, you know, there are problems with sometimes duplicative orders in books. And I've said, well, we've had those for many years and they take 2 seconds to remedy. We all seem to say, oh, isn't this a duplicated order? It gets reversed. It hardly seems to be the basis for some sort of major catalytic change. But I just think that it would be important to try and finesse processes and make something smoother. But we probably need a platform that would work for MTNs as well as for very vanilla bonds, that work for structured MTNs that don't have binary outcomes. So we shouldn't end up with multiple platforms in a difficult way.
Thanks, Isabelle. And Frank, your comment earlier about the sheer number of new issues that your institution has to deal with daily and not just weekly, presumably that means that you're an eager sort of participant in any future initiatives on the tech side and looking to make life more frictionless.
No, that's definitely the case. I mean, we have to, or we had to automatize our internal systems to be quicker in digesting the information that came about with each new issuance. Yeah? So pre-trade compliance, these type of things being checked in a second, literally. And I do think the technical progress that we are looking at in some of the platforms that have been developed is great. We have participated in one of the digital bond issuance in the past, just to see where does it pop up, where does it cause problems along the value chain of the buy side. And clearly the big trouble is secondary market liquidity. Yes, you can buy digital bonds, but whom do you sell it to and where do you sell it to? So the platform issue is a big thing. You need sufficient number of issuers, banks and buy-side participants and investors to be on these platforms to create a new market. And I'm fully with Isabelle. You know, as always with these things, you end up with many players in the beginning, and then you have to have economies of scale, liquidity. Secondary market liquidity is the key word here for this. And I presume in 5-6 years' time, we will have 2 or 3 platforms maybe, or even only one, where we all act digital. So that's my vision at least.
And is it a struggle to align your internal systems with those platforms? And is that one of the factors driving a desire for fewer platforms across the market?
Not really. It's rather connecting the data pools, so sort of the data hubs to be connected to these systems, the reporting tools, and then it's all about custodians, to be quite honest. So it's not so much an issue for the front office on the buy side. You know, it's buying and selling as if it was a physical bond. It's more about the value chain in the middle and back office. So there the troubles begin, and there the efforts are huge. And so from a pure secondary markets point of view, in terms of trading activity and portfolio construction, it's almost no change, to be quite honest. So it's less the buy side as such in the front office, but more the value chain in the middle and back office and the custodians.
Great. Turning to a core topic the rates environment and the changes we're seeing at the moment with the rebirth of inflation and the radical moves we've seen this year in rates. Maybe if I could start with Isabelle. What are your perspectives on how life as a treasurer changes in a world where A, rates are volatile, and B, rates are moving up properly for the first time in half a generation?
Ooh, I think that some of the difficulties, I mean, those of us that are quite old and have been in the market a long time, saw interest rate rises historically. But it's not clear to me that the patterns are going to be exactly the same now as they were back then. So there were certain sort of established views that, for instance, swap spreads would go up before interest rates went up. So they would sort of preview that. And we haven't seen that. So they don't seem to front run in the way that perhaps we might have expected. I think that we'll obviously see a greater focus on floaters, but that sort of feeds into the risk-free rate change and the fact that the market in dollars is a bit fragmented. So I think that's quite interesting where, whereas in sterling, and Toby referred to this earlier, they've really done a very robust job in saying this is where we're going and this is when we're getting there. I think that in the dollar market, we're seeing average rates, compounded overnights, Ameribor, views on different things. So there isn't really sort of one view of what that market looks like. And I think that degree of fragmentation may make it awkward to see sort of liquidity in the way that may have been expected. So I think there are all sorts of different aspects. And I think it obviously is coming at a time where we simply don't know what the funding volumes are going to be for many different people, given the fallout of the war. So I think that it's going to be interesting to see how it works. I don't have a good crystal ball, but I think that there are degrees of uncertainty, but the market at least functions relatively well. And we have to hope that we get all the pieces forming together in a way that should work.
Thanks. And Frank, taking Isabelle's comment about the coincidence in timing of rate rises with the increasing need for governments to raise funds, how does that affect the market's robustness, and how does that affect primary across both the rates markets and the credit markets as we look ahead for the next year or so?
Yeah, that's the key question. I'm pretty bearish actually for the outlook for specifically for credit markets, given the fact that due to the central bank purchases over those years, many investors have been pushed into the still higher yielding credit markets, even not the type of natural investors that would know the credit risk well. And now we are sort of reversing that trend. We see government bonds and agencies and covereds. Actually, there's a rejuvenation of the covered bond market. We have more activity than in the past because the central bank was buying and holding these till maturity. So they were sort of not an active liquidity provider in that sense. Now liquidity comes back to these segments of the market, which are the safer segments of the market. So you have excess liquidity, I would almost say, in the sovereign bond, in the agency, and in the covered bond market. And yet you have much less issuance. You see that already in the high yield markets, European high yield markets, US high yield markets. Dispersion is rising rapidly, spread dispersion. So that means investors are demanding higher yield for higher risk. And that all comes at the time where we see QT coming to us. So I'm a bit concerned about this sort of perfect storm where you have higher yields, higher risk premia being demanded by investors, a shift back into sovereign debt markets by investor groups away from credit markets, and at the same time, potentially even the interest rate cycle that we are facing now, forcing at least a blip in growth, if not a recession to the credit market, and that means credit issuers will have a hard time. And now, if you look at the size of the IG credit market, I'm getting a bit concerned about these type of tectonic shifts that we are about to see. So to me, it's a perfect storm I haven't seen for the last 20 years in credit markets. It has been a very gradual increase in credit spreads so far. Thank God, there's much less leverage in the system, thanks to all the sort of post-financial crisis reforms in regulation and supervision. But, you know, it's going to be tough for credit markets specifically.
And when you're talking to end investors who are sort of passing assets to Union and other asset managers, are you seeing a change in dialogue in terms of their desire to be invested in government bond markets versus super sovereigns versus credit?
Not yet, but we're seeing initial debate about this amongst our clients, and obviously, as yields get more enticing in the sort of safer space of the fixed income markets, clearly there will be a shift back into these type of products. I mean, just to mention one example, before we had the massive decline in interest rates and yields in markets, let's say, you know, in the early tens of this decade, of this 2010 and so forth, we actually had fixed maturity products being sold to retail and institutional investors very easily. That has totally died down. Guaranteed products totally died out. So this will come back to the product space on the buy side, and therefore to what we sell to our clients going forward, if yields for safer products, safer bonds basically pick up nicely, as they seem to be doing.
And in terms of currencies, obviously you're predominantly looking at euros, but do you see the global mandates looking at dollars and euros differently in a rising rate environment with inflation in both currencies?
That could well be the place. The fact, I mean, we have been seeing much more activity in Yankees, in all sorts of, you know, currency diversification plays for credit investors. I think it will critically depend on how unified the response by central banks will be. Is the ECB going to follow? It seems it's going to be the case, the route of the Bank of England, the Bank of Canada, and the Fed in sort of substantial tightening, not just gradual, but rather rampant tightening, or not. And those questions will be then carefully analyzed by us, and then we will decide what to do.
Makes sense. And Reiko, on the Asia side, obviously Japan has been used to very low rates for a very long time. With Japanese issuers, do you see a different reaction function now that the rates picture is changing in the rest of the world?
It's hard to compare the situation in Europe and Asia, but Japanese investors are so cautious to see the interest rate hike in the US and then Europe. And then Japan is still, BOJ is trying to keep the interest rate low as much as possible, but we are now seeing some symptom of the change of the situation. But due to the various uncertain situation in geopolitical situation, people are quite sidelined, to be honest. And then credit spread in Japan are widening. And then people go to short term and then high credit only. So Japanese investors are very bilateral to go into quite high risk situation, but normally they are very conservative, just buying JGB or keep the cash. This is the current situation, and we like to see more development in the global situation. That's the current situation.
Thank you. And turning to sustainability, which is a topic that we've heard a lot of throughout the conference, and I think the primary markets have really been at the vanguard of making it a core part of the European and global bond markets. Do we think that ESG primary funding, whether that's in the form of use of proceeds bonds or in sustainability-linked bonds, is that funding flowing to the right place? And maybe, Jocelyn, if you want to start on that, do you see that the primary markets are achieving what they are trying to achieve in practice on this area?
Well, at the ESM, so we are growing progressively on ESG on three aspects. The first one is on the investment side. So as an issuer, we signed the United Nations Principles for Responsible Investment, the UNPRI, and we have been progressively ramping up our investment into ESG labeled instruments. So that's one thing. Then on the issuer side, we have created a social bond framework for the pandemic crisis support, which is an instrument that was set up at the very beginning of the pandemic, which was not triggered, but is still available till the end of this year. And so this social bond framework was elaborated in coherence with the ICMA social bond principles. So in case if it's activated, then we would issue social bonds. We don't issue green bonds. And I think also another aspect beyond market is also as an institution, there's a responsibility on a daily basis to act on ESG, and can be very simple things, starting from dimming the lights, reducing the waste, to more impactful aspects like reviewing the travel policy. So this is also an ESG aspect that needs to be taken into account at some point.
And is that something that that comes throughout the organization, aside from primary? To what extent does being in the primary bond market with social bonds sort of help to push that agenda internally?
Well, I think there is internally a very strong culture about ESG. Everybody is very aware about that. And many people, as you can imagine, were involved in the setup of the pandemic crisis support. And this social bond framework aspect was a very important one. And I think this is indeed driving the culture and having everyone really involved and conscious about this.
Thank you. And Reiko, how is the sustainable bond market, both use of proceeds and sustainability-linked bonds, how is that developing in Asia Pacific? And how does it differ, do you think, versus Europe, and in particular around maybe the expectations of reduced reliance on fossil fuels and the timing differences between Asia and Europe?
Thank you. First of all, there are commonalities, of course, between Europe and an Asian situation. But as a latecomer, Asian market is very focused on ESG market, first of all. And then we are paying a lot of attention to what's going on in Europe and in Asia, in the US, and looking at the regulatory situation or non-financial disclosure situation and the bond principles set by ICMA. And then the differences are, as you said, that we are heavily still relying on fossil fuel, and so the situation should be considered fundamentally different, but still a lot of countries, including Japan, have announced their commitment to carbon net zero or carbon emission target. In order to achieve it, we need the collaboration between the government and the private sector. And for example, Japan government has announced carbon net zero by 2050, and then they have already announced many guidelines, and some of them are aligned with ICMA. And then we have green bond principle in Japan, social bond principle in Japan, and so on. And then they need the money from not only Asia, but also from Europe and then US, obviously. So they need to be aligned with international standard as much as possible. So, so currently, transition bond or SLB are getting more popularity in order to achieve carbon net zero for high emitters. So hopefully that will get more attraction from European and then US investors as well. And one thing to be to comment is that most of the countries in APAC are still emerging countries, so social aspect should be also considered in, along with the transition or environmental situation, and it's so hard to balance both. So we need to, again, collaborate between government and then private sector to go forward to achieve carbon net zero, while we need to balance again social issues as well. That's the current situation. So many use of proceed transactions or KPI linked transactions, both are quite essential for us to get money from abroad.
Thanks, Reiko. And Reiko, do you think the Japanese issuers are enthusiastic sort of innovators on this topic?
Very much. We are competing together to get mandates from Japanese issuers. They are tapping market domestically, but also internationally. So very enthusiastic, and then a portion of the ESG theme transactions in their whole issuance is getting higher and higher, even this year, difficult situation.
And Isabelle, returning to Europe, the EBRD is a long-standing issuer of sustainable bonds. What trends are you seeing in the market, and where do you see us going in the future on this topic?
Thank you. I think the trend, I think, was highlighted a bit in yesterday's sustainability panel of focusing not just on use of proceeds bonds, but also the issuer. Because greenwashing, as I think Nicholas mentioned, isn't just about having projects that are not sufficiently ambitious, but it's also the tokenistic element of somebody doing marvelous green projects, but continuing with business as usual, which is very polluting. So I think it has been outlined in the principles now for the last few years, but more disclosure about the issuer in the context of their projects, and especially because people need to understand Paris alignment, objectives of the issuer, and whether they're moving in the right direction, just more generally. So not just in the green bond space, but broader than that. I think the other aspect is, and where I think we're going to have to go a bit more, is we're seeing the sort of greening of the bond market, not just the green bond market. Because we find that certainly a lot of investors who aren't buying green bonds are asking us to do more disclosure, more impact, more understanding about us as an issuer. And then I think there's a difficulty somewhat in the fact, as we've just heard, that there are non-European issuers who are issuing to a global market. There are issuers in Europe with projects that are outside Europe, and again, who are not always going to be able to actually link to any one taxonomy, and especially one that's as detailed as the EU taxonomy. So it's not that their projects are unambitious. It's not that their projects aren't at least as green as those that are consistent with the taxonomy, but actually that the data is lacking and that there are other aspects, or that the reference points are very EU-centric. And therefore, we're going to have a better translation of what is green, and not some sort of lazy view that anything that isn't EU taxonomy compliant is somehow greenwashing, which I think is a very dangerous notion. I think there will be things that don't meet the taxonomy because they're simply not ambitious enough, but there are going to be plenty of things that do. And so having the multiplicity of taxonomies, and we're going to get even more of them, we're really going to need to see some sort of understanding of what data can be produced, because it's really important. This is a global problem, and we can't just solve it by having a narrow view of where money should go. And we need to have a better language that we can share between us. And I think that's going to be the direction of travel and where we need to concentrate efforts.
Thanks, Isabelle. And Frank, from the investor perspective, how are you looking at sustainability, and how much of it is looking at the specific bonds going into specific green portfolios versus looking at the companies, the company's culture, the full ESG score and how that affects your view of the issuer in general rather than the bond itself?
Yeah, that's a key issue going forward. I mean, clearly we see a huge development in the way sustainable investments make their way into portfolio management or the industry as such. And it's partially also led by, obviously, by regulation. To give you one example, we all started off investing by using filters, having best-in-class approaches, excluding brown, not social companies, so to speak. So focusing on the good ones, on the high performers, so to speak, amongst the issuers. Now, and regulation has realized that, thank God, and it doesn't make sense to have an already green and social issuer to become even greener. The impact that you have in terms of the first and second derivative on how you improve the environment or the social governance of a company is much larger if a company only starts getting green or more social. So in a sense, what we are doing, we're moving away from best-in-class approaches where we focus on the best performers according to ESG standards, but we need to focus in terms of impact investing and transition investing on the transition from being brown to green, from being not so social to being focused on social, from not being transparent to having a good governance in place. And that makes it difficult. So you can look at the instrument and it looks perfectly fine, but you have to look at the issuer, at the corporate, at the agency, at the government, whatever the issuer is, to see how does he, she perform in terms of the overall ESG strategy. Is it credible? How do we measure it? What type of data do we get from the company and so forth? So in a sense, non-financial disclosure requirements are extremely important for us to judge, to come to a monitoring and judgment on this. And the risk that we face, all of us, is now we move away from the easy part that you invest into best in class, and now you by intention invest into the underperformers who have decided to go on the journey to being an ESG best performer. And that is impact investing. Now consider this, I mean, reputational risks are immense. If the leadership of the company or the government or the agency is not credible, you have a huge reputation risk as an investor. So you need to be in constant dialogue, constant monitoring of the process of becoming more greener and more social and more transparent with regard to the issuers. It's a huge exercise, meaning the processes have to shift from pure data monitoring and picking the cherries out of the issuance community, rather looking at the not so pretty companies and helping them to become more prettier in terms of ESG. That's the challenge. And it needs to be explained to the public, it needs to be explained to the media, and it needs to be explained to the investors, to the clients of the investor groups. It's a huge exercise. I mean, it's breathtaking. So that's the challenge.
And bringing that back to what we talked about earlier, to what extent does technology help you get that data and monitor those companies and keep in touch with what you need to keep in touch with?
I think we had an excellent presentation by, I think, Stephen Fisher from BlackRock yesterday on this, on how they go about the data analytics, the project. I mean, we need to project to be credible in our approach. We need to be able to project the expected improvement in the ESG scores or the ESG performance of issuers. That's not an easy task, and Stephen has talked about that quite in detail yesterday. It's highly data-driven. It's all about data analytics. So yes, these are the key investments to be taken on the buy side to to be able to be credible and have a robust investment process in terms of ESG standards.
Thanks. And just to finish up, and inspired by some of the panels yesterday, what would you each wish for from the primary bond market fairy if we were on New Year's Eve 2029? I'm going to start with Isabelle because she looks like she's anticipating the questions so much.
No. I've no idea that we don't disrupt too much, is my general view. I'd like to see more homogeneity, because I think that it's very, very difficult when we see too much fragmentation. So I think we need to keep bringing more people in and not ending up with things that keep going in different directions. So, you know, it's more homogeneous markets, because I think it's important for things like emerging markets as well, that we don't end up with too many dislocations.
Reiko?
Yeah, I echo Isabelle's comments. So diversity and inclusion was a theme yesterday, but it should be also relevant in ESG market. We should have some common target as the global citizens, but also the pathway to go to achieve the goal of Paris alignment is slightly different. So we should be inclusive, or I hope that everybody should be inclusive to achieve everybody's goal by 2050.
Jocelyn?
Yeah, there is an interesting intersection between technology and ESG. I think that the ramp up of tokenized assets will also authorize to be better on ESG, because you can have better control on the use of proceeds, and even, why not, conditionality on the use of proceeds if you are able to connect to the right data. So it always comes back to the data. I totally agree with Frank on this. But yeah, what I would hope is for this to move forward, because I think the whole market would benefit, but also on the very important ESG aspects. It's not only about tech. Tech is an enabler.
Thanks, Jocelyn. And Frank, finally.
Yeah, I have a final ambitious wish. By 2029, I wish that we don't have any cash bonds anymore. It's that we have a fully digital fixed income market segment with atomic settlement. That would be my dream. 7 years to go, so let's work on it.
Fantastic. Well, thank you to my panelists, and thank you to you, the audience.